The commission. Why agents push certain policies harder than others. Last time, we opened the fine print hiding inside your policy. This time, we go back one step further, to the moment before you even signed anything, when someone recommended that policy to you in the first place. Not every recommendation is built the same way. Today, we open the file on the commission. This is claim denied. Case file number 004, the commission. How agents get paid and why that quietly shapes what gets recommended to you. Most people assume an insurance recommendation is based purely on what fits their situation best. In many cases, it genuinely is. But agents aren't paid the same amount for every product they can offer you, and that difference in pay is rarely mentioned during the conversation. You're allowed to ask how someone is paid. Almost no one ever does. Insurance agents are typically paid a percentage of the premium, often heavily front-loaded in the first year of the policy. That percentage is not the same across products. A simple term life policy generally pays a modest commission. A permanent policy, like whole life or indexed universal life, can pay several times more in that first year, sometimes over half of what you pay in premiums going straight to commission before any of it builds value for you. Neither product is automatically wrong for every person. But when one option pays dramatically more than another, that gap is worth knowing about before you decide which one sounds like the right fit. Tactic 1 shows up in how a product gets framed. A permanent policy can be pitched around its cash value growth, its guarantees, or its use as a savings tool. All real features that exist. What's less often mentioned clearly is the size of the commission built into that structure, or that a term policy paired with separate, low-cost investing could sometimes accomplish similar goals for meaningfully less cost. The bigger picture gets simplified down to whichever feature sounds most appealing in the room. Tactic 2 lives behind the scenes entirely. Many agents work toward internal sales contests, bonus trips, or quotas tied to specific products or specific carriers. None of that is illegal, and plenty of agents genuinely try to separate those incentives from their advice to you. But it's still a real, ongoing pressure sitting in the room during that conversation, one you have no visibility into as the person across the table. Tactic 3 is less obvious: policy replacement. Sometimes a customer is encouraged to drop an existing policy and buy a new one, framed as an upgrade or a better rate. Sometimes that's genuinely true. But replacing a policy often triggers a brand new first-year commission, while the customer can lose years of accumulated value in the old one, plus face new waiting periods or health requirements they didn't have before. It's worth asking directly whether replacing a policy benefits you specifically or benefits the commission structure behind the recommendation. Take a composite case like this one. A young couple came in looking for basic life insurance to protect their new mortgage. They left with a permanent policy several times more expensive than the term coverage they originally asked about, framed around long-term savings growth. Years later, comparing notes with a fee-only financial planner, they found a low-cost term policy paired with their existing retirement account would have covered the same need for a fraction of the monthly cost. Nothing about their original policy was fraudulent. It was simply the option that paid the most to sell, presented as the option that fit them best. Before signing anything, ask 2 direct questions. First, how are you compensated on this specific policy compared to the other options you could offer me? A straightforward answer is a good sign. Vague or dismissive answers are worth noticing. Second, ask for the exact same coverage need quoted at least 2 different ways. A simple term option and whatever else is being recommended, side by side, in writing. Third, consider a second opinion from a fee-only advisor, someone paid a flat fee rather than a product commission, purely to review the recommendation itself. That single conversation costs far less than years of paying for the wrong structure. None of this means avoid permanent policies entirely. For some people, they're genuinely the right tool. It means make sure that decision is actually about your goals, not just about which option paid the most in the room. Commission isn't a scandal on its own. It's simply how the industry pays the people who sell its products. But a bigger number paid to the person recommending something is a fact worth having in the room, right alongside the features they're describing. Ask how they're paid. Get it in writing. Compare it against the simplest option before you decide the complicated one is the right fit. Next time on Claim Denied, what actually happens the moment you file a claim? The exact steps an insurer takes behind the scenes, and where in that process you have more power than you think. If this changed how you'll ask your next insurance question, subscribe. Every week, we open a new file. Ask how they're paid. It's your money either way.